Extreme greed has finally gripped the market as the Nasdaq caps off 4 days of gains. But could there be more to come? Today, we discuss that and Bitcoin. The absolute circus that is the SEC finally approved all 11 Bitcoin ETFs, and we need to discuss what that means for crypto and Bitcoin as a whole. But we also need to talk about semiconductors. Nvidia is breaking out, but the rest of the market simply isn't following. Will the market follow, or is this just another Wall Street fake out? Hello everybody, welcome to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like these videos, please subscribe, hit the like button. Let's get into it. So a green day across the board except for energy and a few select names like Tesla, a couple of the banks. Semiconductors as a whole, except Nvidia, actually were pretty red, but they have been the best performing sectors the last 3-4 days. But other than that, it was really just by the winners of 2023. Now here are the majors, and you could see that large cap growth was the best sector today, and you can see the Nasdaq and S&P 500, the best performing sectors, quickly followed by the RSP, IWM, and bonds put up a negative day. But looking at the sectors as a whole, home builders very strong, followed by software and communication services. Now the talk of the town today were these Bitcoin ETFs, and they got approved by the SEC. What an actual circus. Bitcoin was up 2% today, but it's very volatile like that, and I'm really interested to see what this is going to do for crypto, Bitcoin as a whole, looking towards the rest of 2024. But what completely flew under the radar today was the 10-year bond auction. We had a very solid auction, guys. This is really good news, and this is encouraging looking at tomorrow's CPI data. Now the consensus estimates of 0.2% headline and 0.3% core, but Akamina Research reckons that we could actually see cooler core at 0.2%. So it's going to be really interesting to see what we get in inflation tomorrow. Here is your CPI playbook for tomorrow. So for the S&P 500, if we are to get a headline number that's in line or lower than expectations for CPI, expect the maximum price move of 1.1%, and if we get a hot number, negative 0.8%. And in the Nasdaq, because it's a higher beta, the Nasdaq 100 specifically, 1.4% if it comes in lower or in line, and a hot number, a negative 1.1%. And you can have a look at all of the other sectors, com services, discretionary, staples. It's all here for you guys to view. And tomorrow's data is going to tell us more about what the Fed is going to do with QT. We do know that BofA are expecting QT to start in March and end around July, but Goldman Sachs see it a bit differently. They believe that they're probably going to start the runoff in May and finish around Q1 2025. Now there is a bit of divergence between this data, but the common denominator is that balance sheet runoff is a thing right now, and we're moving away from QT and further into neutral territory, possibly QE. And this has major implications on the economy. So let's actually talk about the economy. We got two lines here, the optimism index, right? Hard and soft. And this is like sentiment readings, and this is what has actually happened in the economy. And what people think is going to happen and what people feel versus what's actually happening, there's quite a lot of divergence. And this is why I put more weight on this than anything else. And let's have a look at the LEI. So this is the Conference Board leading US economic indicator. And normally when we get into deep contraction territory, it's normally a sign we are entering a recession, or recession is around the corner. And for good measure, this has been a very accurate predictor of recessions. But the major flaw in this indicator is that it's weighted to manufacturing and sentiment, which can be arbitrary. A more precise indicator is actually the Carson Research leading indicator, and what they use is consumption over sentiment. And as it stands right now, economic growth in the US is actually running a long trend. And this is further evidenced by a strong consumer. What we're seeing in total household debt is growth in debt is actually decreasing, and delinquency rates are sitting at about the average and well below the 4% mark, which is what banks use for provisioning. Now, looking at bankruptcy rates, personal bankruptcy filings are hovering at multi-decade lows, and they continue to remain low throughout 2020, 21, 22, 23. And we can also see US bank issued credit cards, excluding retail, is sitting at about the average. Look at December 2023, 2% charge-offs, 30 days to 60 days delinquencies at that level, 60 to 90 at that level, and 90 plus sitting at 0.68%. 2%. Now, it is above average compared to the COVID era, but if you have a look at the GFC era, we're well below these statistics, even pre-GFC sitting well below these. So the consumer and credit as a whole is very, very healthy. Now, real wages continue to make gains. Wage inflation sits at about 4.1% currently. This is actually outpacing the rate of inflation. And wage inflation is making its way to the bottom income quartile. More specifically, higher income households' wage growth is relatively weak, whereas lower income households are seeing higher wage inflation, which is really, really good. I mean, this is how you make a strong America. You make the weakest people stronger. And spending growth of lower income households began to outpace that of higher households in 2023. You can see that below 50K earners, their income spend is increasing simply because they're making more money. Furthermore, total card spending per household rose 0.2% year over year in September. And even though it does look just on the zero line, it is kind of bottoming for 2023. You know, at this point right here, everybody was telling us recession is coming and people were very cautious around this time. So what we want to see is an uptick in retail, services, and total card spend. Now, baby boomers were the strongest spenders during this holiday period, and that's because they probably just have the most money. In second place was millennials and then Gen X. We're also seeing a major uptick in mortgage applications. So, you know, mortgage rates at the 5 to 6% rate, people are liking those. We saw a 10% increase or a 9.9% increase in MBA mortgage applications. And what we're also seeing is a decrease in asking rents. And what we're seeing, guys, a decrease in rent, increase in wages. This just means more money in the average American's pocket. That just strengthens them as a consumer, as an investor, and it just makes America and the global economy stronger as a whole, because these stats are seen throughout Europe, throughout Australia, although at different rates compared to America. And US asking rents fall for the third straight month in December. But there are some risks in the market. Looking at Denmark CPI, we're seeing exceptionally low inflation, especially in food prices, cultural and recreation expenses, airfares, transportation, clothing, footwear prices, minimal adjustments. And this trend may suggest that Germany's inflation rate could also be significantly lower in January. And we're going to see what this means for the US for our CPI numbers tomorrow, as well as PPI numbers. Just something I thought I'd throw out there. And guys, we do want a tiny bit of inflation. So this is deflation. This is hyperinflation. Okay. This little area right here, this is where we want to be. Now, let's switch gears, guys, and talk about earnings. Now, this is data from BofA. I've been showing you data from FactSet, and BofA is expecting 2.1% earnings growth for the S&P 500, and excluding financials and energy, 7.2% year over year. However, something that is to note is that we were actually expecting 8% as a whole, and this has decreased significantly. From Q3 23 to Q4 23, we saw a negative 6% decrease in earnings revision, well below the historical average. Now, the earnings revisions for 2024 so far are above trend. This was just something I thought that was incredibly interesting. Now, looking at everything from a bird's eye view, looking at this quarter, we could see here that the best sector this quarter is predicted to be comm services, followed by utilities, but only 5 sectors will report an increase in growth quarter over quarter. But that changes in Q1 2024, where all but 4 sectors are expected to report growth quarter over quarter. And the economic surprise index remains positive, pointing to a 4% EPS beat this quarter based on the historic relationship, and you can see the data. Now, the next 2 to 3 quarters remains absolutely key for earnings as a whole, because we are just coming out of the earnings recession. We had 3 quarters of negative earnings growth. We reported positive earnings growth in the last quarter, and we are expecting this to continue and then ramp up in 2024. Now, these types of earnings recessions are actually great dip buying opportunities. Earnings typically recover stronger than what they fall, and you can see here that 10 months on, most of the time, earnings recover significantly stronger. Now, it's not all good news. There are a couple of risks. Analysts are penciling in the lowest margin since Q4 2020 right here, but we are expecting an uptick in the rest of 2024. And this is especially crazy considering where rates are. But even though we are expecting better margins in 2024, this could be pushed out further into 2025 because of what's happening in the Red Sea. The Shanghai Freight Cost Index, we've seen a spike in 2024, and PCE, excluding food and energy, normally follows this trend. The reason why this is a risk factor is that if goods inflation increases, 51% of S&P 500 earnings comes from goods. And if good prices increase, that's going to further contract margins because companies are going to be stuck between a rock and a hard place. They're either going to have to absorb the extra costs or they're going to have to pass it on to their consumers. And it's probably going to be a 50-50 with taking on some costs and passing on some costs. And that's why those margin increases could be pushed out to 2025. But it shouldn't have a tangible effect on the economy, mostly because 18% of the economy is goods based. But the goods inflation we see here could rear its way into services, but it's really hard to say. We'll have to see how it plays out. But another risk in the market, guys, is mentions of weaker demand continue to be elevated, although we could be seeing an interim top right here. Nonetheless, demand weakening or mentions of demand weakening is still alive and well in the market. Now let's talk about seasonality. This is the typical election year. What we are looking for is some form of a dip buying opportunity in the first quarter. We normally remain pretty flat, and then we do try and find dip buying opportunities around the March-April area before we do run up into the election. Now, I did see somewhere on Twitter, I don't have a source, I did see someone talk about $100 billion worth of tax cuts, bipartisan tax cuts that could be coming in 2024, and that could really be supportive for equities. When we do get more word on that, I will let you guys know. So go ahead and follow me on Twitter. That's where I post everything that you need to know. But let's talk about gamma, guys, and this is very interesting. We are seeing a lot more negative gamma coming to the tape compared to yesterday, especially at the highest strikes right here. Call gamma resistance remains at the 4800 area, and I doubt it's gonna move up. It is very, very elevated, and this is probably gonna stay here until OPEX January, which is the 19th of January American time. All in all, we still are in positive gamma, and the market continues to be bullish. Something I do want to show you is dealers delta. We did have 4 or 5 days of positive dealer delta, and it is now shift to negative. In other words, if stock goes down, dealers make money, right? In other words, dealers are exposed to making money when stocks go down, which means to neutralize their delta, they hedge by buying. So around the January OPEX, a lot of this delta will need to be unwound to the downside by selling stock. So that's why we do need to see if the dealer's delta continues to remain negative or positive. But all in all, we could see that from about here, the October, November lows, dealer's delta is fairly neutral in comparison to this part of the market. And when dealer's delta is negative, we actually are in positive gamma. When dealer's delta is positive, we are in negative gamma. That goes to show that even in a negative gamma environment, we can actually still rally. But the reason why dealer's delta was mostly positive here was because from March to July, this run right here, this was all the mega cap 7. It really was just the AI trade, and the rest of the market, the RSP was about even for the year. Small caps were down about 5%. At this point right here, the RSP was down about 7%. Small caps were down about 15%. Absolutely crazy. And that's because the market internals were negative, and that's why dealers delta was positive, which means consumer retail had a negative delta, dealers had a positive delta. And right here, consumers have a positive delta, dealers have a negative delta. Just something to go off there, guys. Now let's have a look at the charts. The S&P 500, we're approaching this key critical level right here. We do need to get above. If we find resistance here, could signal a double top, but 4800 is the call gamma resistance, and that's where dealers will probably want to take price. Having a look at Apple, we bounced off the 200 moving average, still looks pretty strong, put up a pretty good day today, 0.57%, all things considered. I'm still bullish on the 192 level. Now let's actually have a look at Apple's financials, guys, because it's the biggest stock in the world, but Microsoft could be overtaking it tomorrow even, because Microsoft is $33 billion away from overtaking Apple as the biggest stock in the world. Now Apple's earnings estimates, 2024 EPS is a 6.6, 25, 7.13, and 2026, 7.8. And we are seeing 7%, 8%, and 10% increase year over year for Apple. And that puts us at a 2026 PE of 23.49. Very attractive, all things considered. And a current PE of 28.07. Now, there have been significant revisions to all of this. We could see here that up revisions 22, down revisions 22. On a non-GAAP basis, the PE is at 28.05. We are expecting revenue decreases of negative 2.18, but because of the amount of stock that Apple buys, that's why we normally see year over year increases in earnings. Looking at energy, guys, I'm starting to build out a long position in energy. I'm going to build it over the next few months, but trading at an 8.9x PE, and I do think that probably oil at the current price is probably bottoming out. I see good value in energy at the moment. Now, looking at the equal weight, you guys know my stance. I'm only bearish below the 155 level. We're currently above and consolidating. So we'll have to really see if we do get below, and we'll do have to consolidate below before I do see any downside. But as it stands right now, bullish on the RSP going higher, especially if we break above the 158 level. Now, looking at Nvidia, this is a technical breakout. Yeah, a lot of people saying stuff like, I'm ready to short. My question is why? Why are you ready to short? This looks super bullish. Don't short this. Wait for it to play out. Just wait for it to play out. You want to short, wait for it to come down, back test, and then maybe if you get like confirmation on volume and like a deep red candle, a weekly close candle, then you can maybe look for shorts. But as it is right now, bullish, wait for it to play out, guys. Don't do anything stupid. And here's some semiconductor data I wanted to point out for you. So we spoke about this yesterday. We looked at semiconductors as a whole, but today we're going to be looking at memory. The memory industry, stocks like MU, Micron, they have exceptional growth over the next 2 years. We're looking at 47% year over year growth. And then in 2025, 25.9%. And have a look at DRAM, so random access memory, and NAND bit shipments absolutely increasing. And look at the 2023, 24, 25, and 26 estimates. And you guys can go ahead and read this. In terms of semiconductors, if you guys do want to maybe find value, don't look at stuff like Nvidia, AMD, AVGO. Look at the memory segment, tickers like MU. Now, looking at semiconductors as a whole, something I do want to point out is that Nvidia is having a technical breakout, whereas the rest of the market is kind of like finding resistance. Look at SCMI right here, finding resistance at this point. Sellers came in. It's bullish as a whole, but this is a bit concerning. ASML, it's really struggling to find its footing here after the China news. Looking at stuff like Lam Research, I mean, it did bounce off this line right here, but struggling to get any momentum at all. It's just consolidating. Looking at AMD, again, like Supermicro, finding resistance at this level. So we do have to see how these play out, because if we do see like sell side in semiconductors and we do see like sell side in Apple, that could take the market down. That could be your sell signal. Remember, I told you guys on Twitter, your risk on is Apple bouncing, semiconductors bouncing. If the only semiconductor moving is Nvidia, sure, that can hold up the rest of the market, but eventually it's not going to be enough. So we do want to see follow through of the other semiconductor companies. Now, looking at Broadcom, it's looking strong because Broadcom had its breakout well before Nvidia did. It started its breakout like in mid-December. It was absolutely rallying and it's kind of consolidating here. So Broadcom, bullish like Nvidia. So just something to consider with semiconductors. Keep a keen eye on semiconductors and Apple, because if we do see these start to turn down, especially in the bigger names, that's going to be your risk off signal. But for now, don't fight the trend. Looking at healthcare, XLV, strong. It continues to move up into earnings. Very similar with financials. I mean, we had an update today, but it does look like it's fading. I mean, we're moving higher, but there is divergence right here on the chart. And I gave you guys the playbook on Twitter. I said financials and healthcare had a very solid run, both up 15% from lows, strongest sectors year to date. The big names in each sector kick off earnings on Friday. JP Morgan, Citi, BlackRock, United Health. Unless impressive EPS beats, expect some buy the rumor, sell the news type of price action. If you guys are looking to get into these names, look at earnings. We should see it. There'll be a couple of tickers that do sell on news. And if the earnings do look good, that'll be a way for you to get in maybe 5 to 10% below where it's currently trading. Now, looking at TLT, now it's hovering around here, building a base. It struggled to get over this volume shelf, and TLT really needs to go ahead and try and break the 100 zone. But I think everybody's just waiting for CPI news tomorrow. Looking at AGG, very similar situation. It is looking significantly more bullish than TLT. We are consolidating above this trend line, and really we want to hold here and then look to the 100, 102, 103, 104 area. Now the 4% 10-year is becoming a thing. We are seeing consolidation below the trend line and below the 200 moving day. If we do like tick up above these levels right here, algos are going to come in. So very, very critical that we do stay below here. And again, a lot's going to depend on inflation numbers. But what we did have today was a solid bond auction and price remained where it is. Looking at the Russell, this looks a bit bearish, guys. I mean, Russell really needs to bounce right now. Otherwise, if it does get below here, I think we're probably going to go back to this 200 moving average. So the Russell needs to hold this line. Very, very key for bulls to hold this area. But the small caps have looked the weakest of the sectors this year. I'm looking at NEO. I have a small position in NEO. We'll add more around the 7 area. Tight stops on this one. And I'm looking for a bounce to about the $9 mark. Looking at Bitcoin, last week I said, we're forming this wedge. choose a side, up or down. It's clear we're going up, but there's some pretty ugly candles right there. And many people thought the ETF release was going to be a sell the news event. I think so many people are on that trade. Nothing's really happening but super interested to see what this is going to mean for the rest of the market, these ETFs. Something I also wanted to just bring to you guys' attention, the Bitcoin halving is happening in April 2024. And every time Bitcoin halved, we saw exceptional rallies in all three of the halvings. Absolutely crazy. Look at these guys, 9,000%, 2,000% after the Bitcoin halvings. But looking at data, guys, tomorrow we get CPI as well as jobless claims. It's coming out at 8:30 a.m. And then Friday we get PPI and consumer sentiment. But if you've made it up until here, guys, thank you so much for watching. Please subscribe, hit the notification bell, like this video, guys, leave a comment. Cheers.